A lot of dividend investors right now are looking to invest in Kraft Heinz. This is a company that is backed by Warren Buffett and 3G Capital, and it offers a 4.1% starting dividend yield right now. So many dividend investors are enticed by this dividend yield. They like the fact that this company is growing the dividend really quickly. They like the fact that it's backed by Warren Buffett. They like the fact that it is a world-renowned brand or collection of brands that are very, very well known. And they like the rich history behind this company. However, I personally do not own this stock, and I will not be buying this stock. And in today's video, I want to share the precise reasons why. Hey everyone, this is Ian from ppcian.com. Welcome back to another video about dividend growth investing. So I love the comments on my channel, and one of the comments that has been coming through over and over has been asking me, hey Ian, what do you think about Kraft Heinz? I know you just bought General Mills, you like that one, you like that it's a value in today's market, and Kraft Heinz is another one right now trading at an attractive PE ratio with a really wonderful starting dividend yield. And so I took some time, I looked into this company, and I want to share with everyone today why I will not be buying this company and some of the concerns that I have with this company. Before I can do that, I have to go back in time. And on this chart today, I want to share some of the history because I actually used to own Heinz. I used to own this company. I really liked this company. This was a great company. This is a company that had been increasing its dividends that I plan to hold forever. And then one day, Warren Buffett and 3G Capital came along and they took it. They paid a premium for it. It had a little spike in share price. Nothing that meant anything to me as a long-term dividend investor, someone who invests for dividends and cash flow. And then all of a sudden, I had to redeploy that capital because they took Heinz private. And so let's look back at this. Back in 2012, this is when Kraft and Mondelez split. So before 2012, Kraft and Mondelez were the same company. Mondelez International now is just the snack food division of Kraft. Basically, Kraft is the grocery arm of Kraft, and these two companies split. They split ways in 2012. In 2013, something that happened is Warren Buffett and 3G Capital came along, and then they took Heinz private. This was a publicly traded company. This was a great company, one that I wanted to hold forever, but they took it private. And what was very interesting about when they took it private is they did this in a way that really benefited Warren Buffett. And I'll get into this in a little bit more detail in a few minutes, but basically Warren Buffett decided, hey, I'm going to pay a preferred dividend on Heinz to myself, and I'm going to make all this money off of the dividend, but it's going to be preferred. It's going to be to me. It's not going to go to, obviously, any of the common stockholders because they were all bought out. But anyways, Warren Buffett bought the company with 3G, and between 2013 and 2015, they were getting all of this money from the preferred dividend. And again, I'll get into this in a minute. Back here now in 2015, in July of 2015, this is when Buffett and 3G basically brought Heinz public again. They took it private, they brought it public again, but this time when they brought it public, they merged it with the Kraft company. So this gets really confusing. Again, Kraft Mondelez split, they take Heinz private, they bring Heinz public, and now, we're in 2018, what's next? Warren Buffett and 3G Capital own 51% controlling stake in this company. They have 6 out of the 11 board seats. So what's going to happen next? It's going to be whatever Warren Buffett wants, and it's going to be what is ever in Warren Buffett's best interests because he's the majority shareholder along with 3G. So I read an article, it was on Fortune. I thought this one was really good. I want to just share a few quotes from this that I think are really revealing in this historical event of what has taken place. The first one said, in the Heinz deal, Buffett received, along with this regular common stake, a special preferred shares that paid out a dividend of 9%. Also, last year, Heinz paid $770 million of dividends to Berkshire Hathaway. This is Warren Buffett's company, eating up all of the ketchup company's profits and then some. And so what I want to point out here is this is a game of chess on a very global level. This is a game of, some may call financial engineering. People with a lot of money can buy big public companies, they can reorganize them, they can do all kinds of things. In general, it is going to be in the best interests of those people who are making such investments because they are trying to benefit their own pocketbook. And so with just this whole story of the preferred dividends, taking something private, bringing it public, all of this reorganization, as a long-term investor, I don't like that. I don't like it one bit. And I can see where Warren Buffett's coming from. Obviously, he wants to do what's best for him, but at the end of the day, I want to do what's best for me in my investment portfolio, and what's going to be best for me is establishing a portfolio of companies that more or less are going to stay where they are. They're going to keep growing slowly and steadily. They're not going to be necessarily bought out, although that happens from time to time. They're not going to be reorganized too much because I'm in this for the long term. 30 plus years from now, 50 plus years, even 100 plus years from now, I want the companies more or less in my portfolio to have a similar resemblance to what they have now, although they will have grown quite a bit and they will be paying off many more dividends than they are now. However, with all of this kind of thing happening, it really, in my opinion, is against the best interests of a dividend investor, because if I could have just held Heinz all of this time, I would have been receiving a lot of dividends on Heinz right now. But rather, what happened here is my Heinz was bought out. I had to redeploy the money. There were tax consequences of all of that. So tax consequences were forced upon me by the Warren Buffett deal that I never wanted. However, I had no way of stopping because obviously I did not own enough shares in Heinz to vote it down. And so what I'm trying to paint here is a picture that, and this is going to be controversial, in the world of dividend growth investing, everyone looks up to Warren Buffett. Everyone thinks he's amazing. And he has accomplished, obviously, some really amazing things in his life. That being said, I would say he really has first mover advantage. He got started a long time ago. And what I would say is I respect an investor that is more like the common man, the common person who has found a way to actually live off of dividends and do that in a scrappy manner. That's something that I actually aspire and look up to a lot more than someone who got started a very long time ago and now is playing this huge game of chess. That aside, we will set that aside. I know this is going to be a controversial topic here, but the reason I bring this up is I found in the dividend community that a lot of people tend to follow Warren Buffett around. If he's doing this, they go towards it. If he's doing that, they go towards it. If he's staying away from a stock, they stay away from it. Personally, I prefer to be in companies that are not associated with Warren Buffett or other quote-unquote activist investors. There are activist investors out there. They try to meddle in the affairs of these large companies. They try to say, hey, it's not being run well. I'm going to rip out management. I'm going to completely change things. I try to stay away from that. Now, it is not possible always to stay away from that, because what if, for example, my General Mills stock, Warren Buffett comes in and says, hey, I want to buy that and merge it with all of this. He could do that. That's the risk that one runs. I get a lot of questions here. Ian, why do you own 37 stocks? That sounds like a lot. This is why I own 37 stocks, because if Warren Buffett were to come in and buy out one or two of them and I only own 5 stocks, that would completely mess up my portfolio. But if he buys 1 or 2 of my 37, I'm going to be just fine. And so this is something that I am always thinking about, because I know if my strategy is to work, I need to hold on for a very long time, like I already have been. I've been doing this for over 20 years. I have to keep holding on for a long time, and I need the dividends to compound. And if people are coming in, taking stuff private, cashing me out, forcing me to realize gains, that doesn't do me any good. It just creates a mess. And so I try to stay away from it. And so I know it's going to be controversial, but if you're one of those people out there who really looks up to Warren Buffett, and that's obviously okay, just be wary that if all of the positions you own are Warren Buffett's positions, or the type of positions that he likes to own, the risk with that is this, because these days Warren Buffett and his Berkshire Hathaway are so large that the only way they can really make money is by doing big deals. They can't buy small stocks anymore. They can't buy mid-cap stocks. They're doing big deals on a global basis with big companies. And in my opinion, it's often not in the best interest of the common stock shareholders. So just something to look out for. And because he owns 51% of this company, I will not be buying this company no matter how good of a value it is, because I just don't want to deal with that from a long-term perspective. Now, the good thing is I did note these preferred dividends are gone. Thankfully, right now, there are no more preferred dividends going out to Berkshire Hathaway, to Warren Buffett, to 3G Capital. That is a good thing. And also, he has stated that he wants to keep things the way they are. But as we all know, people change their mind. And maybe when Warren Buffett says that, maybe he means that for the next 10 years. He might not mean that for the next 100 years. And so that is something to keep in mind, that even though he says that, he obviously has the right to change his mind, and with his 51%, he can really do what he would like with this particular company. So anyways, going past this alone is a deal breaker for me. This is why I will not be buying Kraft Heinz, even though I love the company. I think it's a great company. They have such good brands, especially Heinz ketchup. It is the ketchup. There's no other ketchup out there anywhere that is gaining market share or has the market share like Heinz, and that's why I used to enjoy owning this company so much. But anyways, let's just look at some of the numbers. Let's keep going down the chart. It's at $60 a share now. It pays $2.50 in dividends per share. So the yield right now is 4.17. This is why dividend investors like it so much. Getting a 4+% yield, starting yield on a world-class brand like Kraft Heinz is unreal. It is in this market, in a market that's gone way up. That is a phenomenal yield. It's a great dividend. And so that's why people like it so much. Getting 4+% on your money in this market from this kind of company, it's kind of unheard of. So I understand the appeal. Another thing that I love about this company is the dividend per share, quarterly dividend per share, just in the last 2 years. Between July of 2015, August of 2017, they raised it by 14%. 14% dividend growth in the last 2 years, potentially continuing into the foreseeable future, plus a starting yield of 4% means the snowball will compound pretty quickly. So if you buy now, one's yield on cost can get pretty high pretty quickly if this type of growth continues. This is phenomenal growth. Now, one thing I would point out with this company is I spent a lot of time looking at the annual report, and it was really confusing. It was so confusing because of all of this, the history. There are really only 2 years now of operating history of the Kraft Heinz company. Before that, it's not really comparable. It was, you're either looking at Heinz or Kraft. It was messy. The way they portrayed in the annual report is, I could decipher it if I wanted to invest enough time, but at the end of the day, after looking at it for a while, I was done. But here's what I did look at. I looked at 2017 versus 2016. Revenue, it's pretty flat, 26 billion up to 0.4 billion down to 26.2, so pretty flat. Earnings per share went from 3.33 to 3.55, so nice EPS growth. I like to see that. That was really good. One thing to point out that is very important here is the earnings per share that one might see on Yahoo Finance, for example, and the PE ratio that one might see on Yahoo Finance. It's really thrown off because it's not the adjusted earnings per share, it's the GAAP earnings per share. The reason the earnings per share needs to be adjusted is because of one-time tax reform. There's some weirdness that's just happening with the earnings per share. So if you factor out tax reform, this is what the earnings per share really is, and it places the PE ratio at a more reasonable level. I think it was about a 17 or so, somewhere in that range. And so this, one other point on this, when I analyze companies, I like to look at the long run. I like to look at least 5, 10, or even more years of operating history, because this company in its current form has only had 2 years of operating history. It's really hard to make decisions on these types of numbers, and so it's very, very limited data. That's another reason I will pass by on this opportunity. One other thing worth mentioning here, international versus domestic. This company has a pretty high amount of focus in the greater United States. 60% of revenue are coming from United States, 30% plus or minus international. So they have some diversification, but it's very US focused. Maybe it's a pro and a con. It's very tied to the US economy, which probably will undergo a correction at some point in the next few years, in my opinion. But also, because international is kind of smaller and growing, there's a lot of opportunity there. I know Heinz, for example, has a very good international network, but the Kraft brands have a very heavy US focus. What this means is maybe as they bring Kraft internationally, there's a lot of growth opportunity. And so that's something worth noting. I think that's an opportunity for the company. I think that could be a really good opportunity for the company in the future. So at the end of the day, to summarize my analysis here of Kraft Heinz, I just look at the big picture to start with, and I lived this with the Heinz company in my own portfolio. That alone was a deal breaker for me. But when I did go down and go into the numbers in general look good. They look pretty solid. It was very hard, however, to look at them in too much depth because I have 2 years of operating history in its current form. One other thing worth noting, they have a $73 billion market cap, $31 billion in debt, so reasonable amount of debt. Not too dissimilar, though, to other consumer non-cyclicals that I'm looking at, like General Mills, that I own, like General Mills. And so that's okay. But basically, it was a little bit more difficult to look at this company just because of all of the restructuring that has happened. And so for me, I will pass this along. I think another reason that I just don't need it, if you've been following my channel for a while, you know consumer non-cyclical is my favorite type of stock to own. I love these stocks. I own a lot of them. I own a lot of them, not only number of stocks, but in dollar terms. They're not over half of my portfolio, but they're getting up there. And so I just don't need another consumer non-cyclical. And when it comes down to General Mills versus Kraft Heinz, I will go with General Mills all day long. Now, you may be questioning, well, General Mills has slower growth. General Mills has more challenges. Yes, but I am willing to accept those. One, for the higher starting yield. General Mills has a slightly higher starting yield. And also just because I don't have to deal with this, because based on some of the research that I did do, my understanding is Warren Buffett already did look into General Mills and they decided, at least for the time being, to pass. That is a good thing in my opinion. And so I don't have to necessarily, hopefully, deal with some of this stuff again. And so that's why I am looking more towards General Mills. Although what I will say with Kraft is, and the analysts will support this as well, although you probably have seen my video on analysts, so you know I don't place too much weight in what they say. But one of the things that they do have right is the growth trajectory on revenue, earnings per share for Kraft Heinz. It is a little bit stronger. It's stronger position than General Mills in the market right now. And so that's something to weigh. But it's interesting, when you look at all of this type of stuff, and maybe you don't look at the top part, you just look at the bottom part, you look at this, you look at my General Mills analysis, I'll link to it in the description below. Most people, most investors would probably pick this company. They would pick this company because the numbers are better. Yeah, the dividend yield is a little bit lower, but in general, maybe the numbers are slightly better. However, when you're a long-term dividend investor and you're relying on decades upon decades of compounding to happen, that's when this type of stuff comes into effect. And most people, they might not even look at this, but two, if they look at this, they'd have a different conclusion than me. They'd be, this is great. I love having Warren Buffett involved. I want a quick deal. I want a quick sell, because maybe Warren Buffett, what's next? Maybe he brings it private again. Who knows what he does? Maybe there's something he can do to extract more value, but it's a one-time tax event for all of the shareholders. Most people would want that because they want the quick gain. I don't want that because I want the long-term dividends, cash flow that I can use to pay the bills. And so that is where my strategy greatly differs from the way that most people out there think. And I'm not saying I'm right, others are wrong. I'm just saying it's different ways of looking at it. And I wanted to present a somewhat probably controversial, different way of looking at things today because it's how I look at things. So to close out today, I just want to thank everyone for the question. This is a great question. Thank you for asking me to analyze this company. This was a fun one, and I thought that this was one where it provides a different way of looking at things than I've looked at in the past on this YouTube channel, at least. So I think this provided an opportunity to share some unique insights with everyone. Now I do know that a lot of folks out there own this company. I do want to wish you the best. I wish you all of the success in the world, all of the best. This doesn't make sense for me. It doesn't align with my philosophy. It doesn't mean I'm right, others are wrong. Maybe I'm wrong, others are right. I just want to wish everyone out there all the success in the world. Before I leave today, just a friendly disclosure. I do own stock in General Mills, ticker symbol GIS. Also, just a friendly disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. I am just sharing this information on YouTube for fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. Hey, thank you so much for all these questions. Please keep them coming in the comments below. The amount of support from the community, it's just overwhelming. I am so excited. I will do my best to get to all of the questions out there, although my backlog at this point is really long. And so what I'm doing is I'm keeping a running tally of all the questions, and the ones that get multiple questions from different people, I'm ranking them up, I'm voting them up when I'm getting the same question over and over from different people. Also, I am on Instagram. I'm going to link to it in the description below. I'm going to link in the description below to a few videos as well, such as my General Mills one that I think is going to be very helpful, my stock analyst one as well that I think is going to be very helpful. Please check those out. Connect with me on Instagram. I am checking Instagram quite a bit, so if you have a question in the moment, send it over publicly in the comments. I will see it. I will do my best to respond within the day on Instagram, and on YouTube I'm usually responding within 2 to 3 days or sooner. So thank you for all the support. I will see you in the next dividend investing video.